Okay, so hi everyone, this is Finance Meets Real Estate. We have Mike Zlotnik here today. I'm really happy to have him. He's the CEO of TF Management Group. So he will discuss best opportunities for growth in real estate, including redeveloping existing hotels and similar spaces into multifamily, classic value-add multifamily, value-add industrial and storage projects, and why exactly redevelopment is generally more attractive than ground-up projects. So Mike has been a debt and equity investor in real estate since 2000. He spent nearly 15 years in IT in different fields. He joined Tempo Funding in 2009, and he has been the CEO and founder of TF Management Group since 2014. So he has done a lot of things in the field, and has plenty of experience. He's here to share this experience with us. It's really a pleasure to have him. So if you guys have any questions, feel free to put them on the chat. We do we do like Q&A via chat first, and then we're going to open up at the end as well. So with that, I'm gonna pass it on to Mike.
Thank you, Stefan, for your gracious invitation. I'm honored to be part of your group and join the group and present on the best growth opportunities in real estate today. Wonderful disclaimer. We're required to put it out because we're going to talk about some of the deals and some of the funds that we have, and all this is for educational, informational purposes only. We're not offering any kind of advice, nor are we offering to sell anything at all. If anyone is interested in our family of funds or any or any of our deals, request PPM, the private placement memorandum that is available to accredited investors only. So that's I have to go through the wonderful disclaimer. All right, just a couple of words about our team. Some of you may know Alina, some of you may not, but Alina introduced us, Stefan. So I'm the CEO. Alina is our head of investor relations and marketing. We have Yuri N, our chief operating officer. We have Yuri G, our chief technology officer. We have also Lilia. And again, I cracked the joke that we have two Yuris, Yuri N and Yuri G, and I did not bring them on board because of the first name. There was nothing special about Yuri. It just happened to take place. So that's our team, and we have our favorite pets here. So we'll skip the pleasantries. I'll move into the presentation. Okay, so let's just start a little bit about just a couple of words about inflation. A really important point today, because we all live in the world of sort of inflation we haven't seen in quite a long time, and it seems to continue to accelerate, and it is a substantial. On one hand, is a concern. On the other hand, it's a phenomenal help to real estate. Generally, real estate is very welcome to real estate investors in the equity space, because during the inflation, rents rise, incomes rise, and obviously cost of materials rise, but overall it increases the value of real estate. So again, just pulling a little bit of recent data, the CRB index, by the way, you could Google it. It's a great index that tracks a bucket of commodities. As you can see, it's been exponentially going up since the bottom of the COVID. So we're certainly seeing very substantial inflation in the United States as far as the commodities, as far as the price of everything. You go to the grocery store, you see the milk is up, everything else is up. On the other side, we are seeing wage inflation, which is really important. People are beginning to make higher incomes. For years, inflation in the wage space has been slow, and it has accelerated recently, part of it as a result of the unemployment benefits. On the other side, there's been very, very shortage of the high-skilled labor, and in the IT and technology, there's been some level of accelerated wage inflation as well. But let me keep rolling forward. Again, inflation is here, and it's a critical piece to this presentation. Again, real estate continues to do really well in the inflationary environment. 1 to 4 family residential, many of you have heard of the Case-Shiller index. It's been on a rise, especially in the last year and a half. Sort of COVID, as we all were concerned, was a terrible thing for the world, but it has done a service to the real estate. The real estate has continued to appreciate. The Case-Shiller, I believe right now is around 16% annualized rate across 20 metropolitan areas. It is phenomenal news for real estate investors, or has been. Again, very low inventory, still very low interest rates, massive government stimulus, and then government direct transfers through unemployment and other benefits. All of those factors have attributed to the real estate market being very hot. On the commercial side, again, just capturing a little bit of the state of the market. On the commercial side, multifamily is doing very well across many sectors, especially assets with good collections, other than really, really difficult assets. Most of the multifamily properties are trading very well, especially affordable housing in high demand. There's very limited supply. Self-storage is doing quite well from the beginning of the year, again, reflecting inflationary environments and operators being able to pass a little bit higher self-storage rates. So we're observing this inflation everywhere. Retail sector has recovered well across the board, other than obviously a number of enclosed malls, and some of them are still struggling. But in general, retail sector was a substantial concern right after COVID hit because of the shutdowns. Now a lot of it has come back, and it's not a perfect recovery, but it has recovered well. The one sector or two sectors that haven't done as well, or it obviously depends on the location, but there's been still substantial concern. Some in the office, some in the hotel space. Now your vacation hotels, your getaway hotels are doing great, but your business travel hotels are not quite there yet. And office is also recovered to only a partial degree. So we'll talk a little bit about that. That creates an opportunity for some of the conversion projects from hotel to multifamily, from office to multifamily. We'll cover that shortly. Again, some commercial assets are still struggling. Again, hospitality and office, as I mentioned, work from home trends have settled in. Long-term demands for certain hotels and office spaces uncertain. And as the result, it creates conversion opportunities because the highest and best use for these type of assets is no longer their previous use, being office or being hotel. And location is obviously the key, like everything else in real estate, location, location, location. So today we see four primary growth opportunities. It's a wide world of opportunities out there, but these opportunities is what we focused on. We've seen a ton of opportunity since the COVID hit, and then we've been able to take advantage of these opportunities, invest in these sectors, and we find them to be very attractive on the economic basis. Plus, they have the good benefits from the point of view that when we convert an old hotel to multifamily, and especially affordable multifamily, we feel great about the project because it helps community to create more affordable housing, which is in dire need in many cities and towns. Again, hotel to multifamily conversion, especially affordable. Office conversions to multifamily, generally speaking, those are more difficult projects, but there are plenty of interesting opportunities. Value add storage, this is not new. It's been around, obviously, but we still see good opportunities with the right projects and with the right operators. And then your classic value add multifamily, when you're taking somewhat of a aged asset with old roofs, old siding, old curb appeal, below market rents, and then renovating all those things and improving rents, improving the look and feel of the environment of the community, and also being able to increase rents and improve the economics of each project. So let's dive straight into specific examples. Again, hotel to multifamily conversion. So how does it take place? How does the whole process work? So we'll talk a little bit about that. We'll start with typically low-rise hotels. There are plenty of opportunities with high risers too, and we have one legacy project, and I'll show you an example in a couple of slides, where a conversion of an old high-rise building to a sort of boutique hotel to multifamily has taken place, and the project has done really well. But today, most of the projects we see, they're not high-rise. They're smaller hotels, and that's the classic example today. And I'll show you a few live examples. Typically, the acquisition during COVID has been off the market, especially distressed hotels. Now, many hotels have come back and are performing. Some are performing not as well as they were doing pre-COVID. They may still be conversion opportunities. So the fact that we're recovering doesn't mean that these opportunities go away. There are probably fewer of them, and some hotels were dysfunctional pre-COVID, and they were completely knocked out during COVID, especially if the sponsor or the operator was not able to maintain them well. And I've seen this live. I've gone to these properties, and you see sometimes a hotel with 4 kind of buildings, and one of them is completely out of commission because of the deferred maintenance. They were not able to operate. They're only operating 3, and they're kind of barely surviving. So some of these opportunities do exist. Again, off the market at a great price. Obviously, the buildings need to be purchased at a good price, a critical requirement. Again, some units can be rearranged. 2 studios could be, or 2 small rooms could be combined into 1 bedroom. Sometimes the project creates a bunch of studios. Sometimes they get connected and they turn into 1-bedroom apartments. Obviously, in order for an apartment to be an apartment, we need to have a kitchen.
Like, if I may interject, so just out of curiosity, would you say, let's say, some of the dislocations in the hotel space during COVID, let's say, assuming there are such, would you say they have already been resolved, or are you seeing some of those
We're still seeing projects coming through. So the massive dislocations are sort of, they're no longer the way they were, obviously. No longer hotels operating with 10, 20% occupancy. But there are still hotels that are operating at a distress. There are some student housing projects, sort of where the hotels near college campuses, and until students come back, or it's not the same level of demand for the events. The events, the student, again, the universities and colleges are back. Many of them are back to sort of full attendance. But there's still limited number of events. There's still some levels of reduced activities. So some of the hotels conversions that we're seeing are some extended stay hotels that are were not well positioned. They were designed to be potentially to host some of the parents for students, but for some reason they're malfunctional. So we're still seeing the deals. We had a couple of fresh deals where in June. We're now in August. We haven't written a fresh check in that space yet, but we've been writing checks almost every month for every 2 months since probably June of last year all the way into June of this year. So for 12 months, we saw plenty of opportunities. You may be right that the number of opportunities is smaller today than before, but I am still seeing plenty of deals. So it's not completely go away. There are still opportunities if you know where to find them with the right operators. So my observation, again, we funded a couple of deals in June. We'll probably have some more. I actually saw a deal coming across my desk. I want to say in late July. So they do take place. At that point, we didn't pick the deal because we had another location sort of in the same town. We decided to diversify, but the answer to the question is opportunities still exist. And again, adding kitchens or kitchenettes is critical. Setting up a property management office. Typically, these projects take between 6 to 18 months. There are some really light conversions that can be done very quickly. Most of them take probably 12 to 18 months, as some of the permits and approvals may take longer. But the actual work quite often will take under 12 months. And then obviously feasibility, really important for these conversion projects. Highest and best use analysis, property feasibility study, market feasibility, site suitability, and so on. Financial modeling is obviously critical too. Investors want to participate in a project with great economics, not just because it's a good project. So otherwise, they'd call it charitable project. So, All right, let's jump into some examples. So this is a pre-COVID deal, and I wanted to show this as this strategy existing pre-COVID, and the fact that we're back. There's a lot of reopening. Things are not perfect, but there's substantial improvement from the bottoms of the COVID. These projects existed pre-COVID. This was a boutique hotel, and this was a conversion from essentially boutique hotel to multifamily, kind of higher end. This was not affordable. This is in Ogden, Utah. And this project, I'm also showing a little bit of economics. The deal had high leverage. And obviously leverage creates two things. It creates substantial upside, and if project fails, it creates a downside. So leverage works two ways. We participated in a $2 million equity. We only took a small piece in this deal. This was our first kind of first trial in this sector, but the project was a massive home run. So all-in cost was about $13.5 million, and the project was supposed to sell for $18.8 million in 5 years. What was really amazing, it sold in the middle of COVID in February 2021 for over $20.5 million. The initial projected return to investors, IRR, was over 25, right around 25%, which is a pretty strong number. What we wound up receiving is IRR over 73%, 2.2 times multiple. Again, it cycled from May 2019 all the way to February 2021. And one of our funds invested $250,000, and we received $546 with change on sale. So this is an example of a deal that pre-COVID that worked out really well, regardless of COVID. Now we'll show you some classic examples of these opportunities. I like to call there two primary flavors of this ice cream. I don't know how else to call it. You have the extended stay flavor, and then you have the kind of Ramada-like hotels. The first one I showed you is a rare example. It's not a typical deal. This high rise is not what we see. Off the top of my head, we have 8, 9 deals of these deals in the portfolio, and then virtually apartments. They typically have a small and they become easy conversions. So this is one deal we funded off the top of my head, I want to say September last year. And it was 88 unit conversion of Residence Inn, Marriott flag to apartments. And the strong part was that they already had kitchenettes installed. Overall, the conversion was fairly easy, and the rents were the rents to be offered are well below the market. Now, these are smaller apartments, but location is the key. This particular property is in Winston-Salem, North Carolina. It's about a mile away from the Wake Forest University, and then 6 miles away from the Wake Forest Baptist Medical Center. Overall, the project is a strong success. What we hear is probably might even sell way ahead of the 5-year hold with returns above the projected numbers. But here are the economics in the deal, just to give you an idea what the numbers look like. When these type of projects come to funding, as an investor, you always want to see good returns. By the way, you always want to know how an operator or sponsor makes money. You want to dig into these numbers. You want to have a pretty good clarity what you're investing in, as if you don't understand what the economics are, and it's a black box, you have to stay away. You just don't know. It's a high risk. So we definitely dig into the underwriting. In this particular deal, the acquisition price was $4.6 million. As you can see, construction relative to the acquisition is fairly light. There's 88 units, $750,000 budget. It's less than $10,000 a door. It's not a very expensive, not a heavy lift. And this includes internal and external. So overall in this project, all-in capitalization was $5,900,000. And of which there was an equity piece for $1.5 million. There was also man's debt for 1.4 and $3 million primary debt. And the reason it was structured this way is to optimize capital. Investors who invested in the senior debt they received lower yield with lower level of risk. The mass debt received better yield, and then equity took a higher degree of risk, but its upside substantially higher. So we took, interestingly enough, we took a piece from two different funds. One fund took a piece in the equity Tempo Growth Fund because that fund its mandate is to invest into the growth deals. And then our growth and income fund, Tempo Opportunity, took a piece of the mass debt. We liked the safety of the deal and knowing that we're actually behind that, the equity is behind the mass debt. To make long story short, the project, again, is going extremely well. On the cost basis, all in $6 million. From what we hear, it's at this point almost done. It's likely to sell above the projected 7.95 million. We hear rumors and whispers it could sell between 9 and 10, which is substantially higher and will generate even higher returns. Again, we don't know that. There's risk associated with this, but it appears that there's high demand for this type of renovated, refreshed hotels into multifamily, and the project economics are pretty strong. Again, just look on the surface, the $1.5 million equity, if things just go per the projections, makes $2 million upside. It's a good enough upside to generate strong returns to investors. And then on the project kind of workflow and the return on equity, rehab plus stabilization is between 15 and 18 months. It should not take longer. In many cases, it could take less. And then this project was originally planned for refinancing upon stabilization on a 5-year hold. What we hear, it might just flip because the offer is so much better now that it's the sponsor in this particular case is just motivated to basically flip the property. So again, original projected return to us was 21.45. The deal goes, as I mentioned, faster and better than the projected price. This number could be another 50-60%. It can go through the roof if the project sells faster and way above the projected price. Here's another flavor of the ice cream. That was vanilla, now this one is chocolate. From the point of view, this is the literally Ramada branded hotel. It looks like a motel. This is in Mesa, Arizona. Downtown Mesa, Arizona. It's got a great location right next to a train stop, light rail train. And it's got an inside courthouse with a pool and normal hotel amenities. So it becomes a good residential community. So this particular one is being converted to a bunch of studios. So who is going to live in these studios? Who is excited to live in a hotel room with a small kitchenette installed? Well, apparently there's a lot of demand for that. And this train connects 3 or 4 universities to these communities. And students are notorious for being sensitive to, that's why they said poor students. They're very price sensitive. They need affordable housing. And I remember myself going to school, and I lived across the campus in a converted hotel to an apartment years ago. And I thought this was the greatest thing because the price of campus was cheaper and you had the privacy. So this demand for this type of studios, especially if they are near student housing or just workforce housing where people work very hard, they want their own private place to crash rather than having a place with a roommate. So again, this is a Ramada, and this particular deal here, the economics of this deal. So all in, so acquisition price was 6.8 million. The construction was heavier. As you can see, it's 3.1 million. There's more work on this project. So this project is probably going to take the entire 18 months to go from start all the way to completion. All in capitalization around $11 million, with equity being 4.2 million and debt being 6.75, which is a typical ratio on a deal like this. This deal did not have any mass debt, it was all equity. And the target sales price is $15 million. Again, on this property, as amazing as it sounds, we're hearing rumors that there are interested buyers for $17 to $18 million, way above the projected amount. Again, no guarantees. The project is still live. We don't know how it's going to play out. But again, on a $4.2 million invested, the projected return or investment almost doubles the money, doubling of the capital, which is it's a good metric, kind of 2x, as a way to measure success of the project. Yeah, Stefan, feel free to jump in with any questions. Again, you can see the pictures here. It's an internal courthouse, and it becomes, good amenities, hotel amenities for an affordable housing place.
So let's say, Mike, just quick question. So let's say some of the, I don't know, zoning approvals and that. So how do you gauge the regulatory side?
Yeah, that's a great question. That all those things are part of the initial study, feasibility study, approaching the city and checking the appetite. Is the city interested in the conversion project? You don't want to just buy a hotel and then go apply for zoning. What you want to do is research the feasibility, approach the city, understand what would it take to do a zoning modification. Some of these hotels, interestingly enough, may have a that area may have by natural right the multifamily zoning. So we've seen this off the top of my head. I don't remember which one it was. I think the Winston-Salem project was naturally zoned for a multifamily. That project did not require any modifications. This particular project in Mesa, Arizona, they had to go to the city, and city came back and wanted some more improvements in the area. It was kind of interesting. On this project, the budget got a little bit expanded because the city wanted the operator to do more to make the city greener, make the property more appealing. So it is a possibility that you will run into some level of, I want to call it resistance, but more of conditions with the city, and you have to be prepared to meet them to get the approval. Does that make sense?
Yes.
So this particular one, again, very similar, projected 18 months, 15 to 18 months timeline, and target return on a 5-year hold, just over 22%, sorry, just over 20%. But if it sells faster than that or at a price higher than that, then these numbers obviously can be substantially enhanced. Now, I don't want to understate the risk. It's a conversion project. If a project fails, you can lose all your money. Just to be very clear, these projects are speculative in nature. They require good underwriting, identification of a high quality sponsor to be able to execute on the strategy. The conversion is not trivial. It's not for, I would call it, mom and pop investor. This is for a very competent operator. Now, most of our investments have been with the same institutional group. We are a fund of funds. So what we do is we find these high experience operators, and we invest with them. We don't operate these projects. So we act essentially as a capital provider, as well as diversification provider. But doing it with the competent operator is the critical requirements. It's got to be the right operator, it's got to be the right project, it's got to have the right economics. All those three things matter. You can't just go blindly into these projects. But the opportunity on the return is very substantial. If things go well, you could get these target returns of 20s. If things go really well, the numbers could be substantially higher. Okay, here's another example. Go ahead.
You guys, you said you're a fund of funds, so you actually source operators who are specifically doing, hotel to multifamily and office to multifamily conversions?
We do a little bit of that. So if we like the sector, we typically find one or more groups we like to work with, and we invest heavily with them. We go deeper, especially if they're very high competence and high integrity and high operation. On the other side, we don't necessarily look out. We just want to find 20 operators who do this. We do want diversification at the same time. Finding a great relationship and being a programmatic capital provider enables us to negotiate better terms and enables us to get the deal flow. Does that make sense? Okay, so next project, we're going to talk about office conversion to multifamily. This is also an opportunity, and this particular building is right next to St. Louis Cardinals a ballpark. It's literally, you could see you're on the side of the field where the home runs fly. I guess if it's a super home run, I don't know Probably would have to go 600 feet to get to the building, but you could watch the game from the rooftop of this building. So this building is an office building right next to the ballpark, and it's dysfunctional as an office, and it became a highest and best use, became a very interesting conversion project. So in this project, we invested only $500,000. Again, as a fund manager, we diversify. So without getting too much into the details, if a project may have a $4 million raise, we can write $500,000 check, $1 million check. We manage our exposure to each project. It may be the best looking project today, but you never know what's going to be a great deal and what's going to have problems. So diversification is always a strong risk mitigation strategy. Again, this is being converted to a little bit nice apartments. This is not affordable. This is going to be kind of high end with a rooftop bar and a rooftop experience. And the target return on this deal is a little bit lighter because of heavy construction. But overall, when we looked at the deal, we underwrote the deal with a sponsor. There was a lot of upsides, and the underwriting was pretty conservative. But as you can imagine, in an office building, you have to move a lot of plumbing, a lot of electric, a lot of work within the building, even though the shell may be great, but the internal renovation is a whole lot heavier than if you're picking up a hotel with a bunch of rooms already existing. All right, so let me keep rolling forward. Some examples of the traditional value-add multifamily. So this particular deal.
Mike, sorry to interrupt. So the prior one, so 500,000 is just your fund of funds investment. That's not the
sorry,
that's not the entire project investment.
Correct. So this particular deal, I don't remember off the top of my head the entire capital stack. I think it was $4 million, and then there was debt on top of that. All in on this project, I have to pull up the data, but I believe all in was somewhere around 16 or $18 million range. This was a substantial investment. So we took essentially $500,000 position in a $4 million equity. So that's what we do. Again, would we take a $4 million opportunity today? What we do is, and again, full transparency, the Temple Grove fund that took this position is a $25 million fund. So for a $25 million fund, our sweet spot is between $500,000 to $1 million. Why? Because we want to diversify. If the fund was 100 million, I could probably do $4 million deals. Does that make sense? And as individual investors, we all have the same situation. If we investing $2 million, do you want to write checks for $500,000? The answer is no. You're probably writing checks for $100,000 or $200,000 to the degree of comfort. So the point here is discipline of diversification should not be ever forgotten, no matter how good the deal is and how interesting the deal looks. Does that make sense? Okay. So another project, Riverbend. This is really interesting opportunity. This is Indianapolis, and this is 996 units. It's a big community, 1,000 doors, and it was a great location, but it lost a curb appeal. The community was overgrown with weeds. It was poorly maintained. The buildings looked kind of, not well maintained. And we have a relationship with this sponsor, and this sponsor is a specialist in Midwest. All they do is value add projects in Midwest like this. They have now 4 projects in Indianapolis. So they have economy of scale, they have the crews, they have the capability, they have the experience. This was incredibly important for our underwriting purposes. So when you're looking at the sponsor to invest with, you have to have very high degree of confidence that they're high integrity, they have high capability. Picking and choosing the sponsor is important. On top of that, this deal happened right smack in the middle of COVID. Like literally, one of the investors bugged out of the deal, and the sponsor was looking for alternative financing. And they approached us. We worked with them in the past. And interestingly enough, we took actually a big piece on this deal. This was a large deal, and we took a $3 million piece in an equity, which was 10.3 million. We almost took 30% equity. But eventually we sold off a piece of it to maintain diversification. So we like the deal. The deal was a really strong deal, and almost today I regret selling it off as a fund manager. But on the other hand, as a fund manager, I have to maintain diversification. So I don't regret selling a piece off, But this deal is a really strong deal. So it's got a target return over 26%. The deal has a truly institutional waterfall. You do not see this type of deals normally. Very few sponsors over these type of deals. And this was kind of in the middle of the COVID when he lost all the financing. The sponsor was very motivated. He came to us and said, listen, I'll guys pay you 12% pref and 80-20 split, 80% to investors, which is a very, very strong terms. So we liked the deal. We liked the operator. And as I said, we wrote $3 million check. We sub-syndicated 2.4 of that. The fund kept 600,000. So at this point, what's really amazing, these post-renovation rents, because he's doing such a great job with these units. He did all the external renovations, the roofs, the sidings, the curb appeal, make the property a lot more attractive, and then went into doing the units. He's getting rents far above the projected $1,019. So the project looks phenomenally strong. The only thing the sponsor is known for, he's trying to do more units per month than projected. So he stopped distributing cash flow. But for us, it's not a big deal. We don't really care. I would rather have the property renovated faster than refinance for faster than seeing the cash flow. So when you consider investing in deals and this projected cash flow in today's environment, just take it with a degree of salt. Because if the project runs into construction issues, the budget issues, I've seen this all day. The sponsors, they project the cash flow, the project starts, the cash flow stops because the renovation's taken more budget or more time. Just be prepared, whatever you invest in, psychologically prepared that these numbers are not guaranteed, they're projected. Just making sure folks are very transparent about it. This particular project also had a cost segregation study and had massive accelerated depreciation, which is very helpful to some investors. It's another discussion for passive investors. It helps offset other passive income, and for real estate professional, it helps them offset any kind of income if they're making the grouping election on their taxes. So this was a multifamily project.
Mike, sorry to just to hold you here for a second. So could you clarify the part institutional terms, 12% pref and 80-20 above? So sure. That's as a fund manager, and then
when we invest and again, when you invest in a fund, we have our own waterfall, and I'll show that in a minute. But as a fund manager, when I invest in deals, again, being fund of funds, we invest with the sponsors. And on a deal like this, the entire 10.3 million was basically sold to, I think, 3 investors. We took 3 million. There was another investor. We took a big chunk, and then the rest went to the sponsors, kind of friends and family. So when we negotiate the terms, we negotiate the term for us as a small institutional investor to get paid 12% preferred return, then full return of capital, and then 80% of the upside on sale of the asset or a refi. Does that make sense? It's 12 pref, 80-20 over 8, which is considered to be very strong. A lot of deals you see today in the multifamily space, you see 8 pref and then 70-30 over 8. Again.
Yep. Agree with that second part. But just to clarify, when you say institutional investor, so you are an institutional limited partner investor or an institutional.
Correct. We are like a mini institutional limited partner in the deal. Exactly. Thank you, Stefan, for the clarification. Exactly that. So we're acting as a small institution, negotiating top terms for our investors. And what's fascinating today, the same sponsor is offering much worse terms. We still like the guy. We're still looking into his deals. Just in the middle of a COVID, it was kind of crazy. We were nervous. The deal closed in June of 2020. We knew we were just coming out of shutdowns, and who knew things could have run much worse than they are now. We took a little bit of leap of faith. We knew that sponsor. We felt it was a really good deal, the really good terms, and we moved forward. But normally, if you're coming in as an LP, it's very hard to get this type of terms. It's almost impossible today. You have to be really, you have to write a really, really big check. Just a couple of words about storage. So like the sector, so we're seeing still really interesting opportunities in storage. But we are shining away from ground up projects. There's a lot of risk associated with ground up. And what we prefer today, and we do invest in some more moderate value add, some conversion projects, but ground ups to me just feels in today's environment, it's too risky. It's going to take them a long time to get to the market. The construction itself takes longer, and then lease up is slow. So what we like more today, basically funds or individual deals that have existing cash flow. So you're acquiring in-place income, but there is a decent, light to moderate value add. It could be management. It could be some additional units on the property, some additional construction expansion. And in general, what we see in some of these deals on the high quality operators is 8 pref and then class A units, typically 80-20. Some people have class B 70-30. So when you invest in these deals, the terms have to be institutional. I've seen pretty crappy terms, 8 pref 50-50 over 8. When these terms are offered to us, we immediately say thank you, but no thank you. As a fund of funds, we write bigger checks. We need to capture genuinely better terms. And individual investors sometimes have the ability to negotiate a little bit better terms. Quite often, and this is a basic technique, I'm not saying it always works, but sometimes you got to go step on sponsors' toes. If you invested with them on 1, 2, 3, 4 projects, you could say, listen, I'm a continuous investor with you, and I provide programmatic, systematic capital. Can I get a side letter? Can I get a little bit better terms? So we do that. I mean, I'm a big guy. It's a funny thing. As you can see in my background, it says Big Mike Fund. I go as a Big Mike. I have a podcast called Big Mike Fund Podcast. But that aside, I'm a big guy. I'm 6'4". I'm on a heavy side. And I correct the joke. When I step on people's toes, because I'm so heavy, they actually yield a little bit. But the reality is, it never hurts to ask for a side letter. Worst answer you're going to get? No. These are the terms, and that's all. Take it or leave it. So always, whenever you invest, and just ask the question. It doesn't hurt. If you ask the questions us in our funds, we generally don't do side letters. But from time to time, if you came in with a big check in special circumstances, you can move, what do you call it? Irresistible force moves immovable object. So if you're coming in with irresistible force and you have enough weight, you can negotiate better terms. So anyway, what I do like today is getting some cash flow on these storage deals. What's really interesting is inflation is kind of could be a substantial upside. Why? What we've seen in Q1 and Q2, sponsors are able to push the rental rates up because there's inflation out there, and self-storage facilities, the demand is fairly inelastic. You can have $100 a month rent and push the rents up to 110, and many people will stay. They don't want to, drag their stuff out of a storage to go another couple of miles out to save $10. So the opportunity is really get into the facilities that are well managed, and then increase the rents, and that creates substantial upside. 10% increase in the rents magnifies NOI by 40%. So there's a lot of upside through that in storage.
So Mike, yeah, just that last comment. So what you're saying, just your comment essentially translates to, okay, self-storage has low expense ratios. So, okay, so it's like factor 4 of NOI increase over the growth.
The way to think about this, just to be very clear, on any leverage deal, you typically, your NOI is only, let me put it this way. If you rent an apartment, just for sake of the argument, or storage unit for $100 a month, your taxes, insurance, mortgage, and all those expenses, they could be $70 a month per unit, just if you think about it on the unit basis. So your profit margin is $30. What if the profit margin is even smaller, $20, $200 a unit, or $20%? When you increase that NOI by 10%, so if your profit margin on a unit, $100 a month was $20 a month, and you increase the rent by 10%, by $10, your profit margin went from $20 to $30. Does that make sense? That small 10% increase in the rent can be magnified to represent 30, 40, 50% NOI increase. And that can substantially enhance the sale price upon exit of the property. So this is how leverage works. Did I answer your question? I just want to make sure I explained it correctly.
Yes. I mean, it's leverage, but it's also sort of a function of what your expense ratio is.
Yeah, expense ratios on a lot of these properties are they usually, what do they do? 40%, most of the storage facilities. Sometimes they're higher, sometimes they're lower. But if the expense ratio is 40%, you and then your debt service is another 40%, you're on 80%. You're operating for 20% margin. So if you increase by 10%, that's what I'm referring to. But you're right, expense ratio is obviously critical for sure.
I mean, debt service is, just for the sake of debt service, is not part of the valuation. That's sort of your financing side.
Correct, but you're absolutely right as far as the cap rate computation and the price. But as your cash on cash return, you actually see that your NOI after debt service is more magnified. That's what I meant. You are, yes,
yeah, absolutely.
Yeah, the leverage cash flow. Thank you for that correction. Just a couple of words about Temple Growth Fund. So we have a family of funds. This is our growth fund. This is the fund that has invested into many of these assets. And again, just very clear, I'm not promoting the fund. Just wanted to explain how the closed-ended funds work. It's really interesting. This fund is going to close in another 4 to 5 months. And people have asked me, how do I get back into these good projects? I can't find them today. How do I get into them? They're not as good anymore today. The opportunity is not as exciting. Well, the answer is you could pick a fund like ours, a closed-ended fund that has 2-year timeline for capital raising. You could find another fund that does something similar. So we started raising capital in January 2020, then COVID hit, and it became kind of a great opportunity for us to invest post-COVID into the deal flow that was somewhat better. It was distressed to a degree. So if you find a fund like ours that still hasn't closed and you can still enter the fund, you can actually participate in all the deals the fund is invested in. It's a very simple technique. Most people don't quite understand, how can I buy into the deals that were already closed in the past? Well, you can't buy into those deals, but you can buy into a fund that's still raising capital that hasn't yet closed. So Temple Growth Fund is one of these funds. There are similar funds that have the same benefits, essentially. But the fund itself is a closed-ended. We started raising capital January 2020. We are closing capital raising January 2022. We're diversifying among multiple strategies. The target return to investors net of all fees is 12 to 18%. Again, it's not cash flow. It's annualized average return over the life of the fund. It's tax efficient. As you can imagine, a growth fund passes a lot of depreciation, a lot of passive losses, because a lot of our projects in the early years, they don't generate any income. They're going through conversions. So it ton of tax benefits. The fund itself, because it's closed-ended, after we close it, it runs 5 to 7 years. A lot of projects will come back a whole lot earlier. A lot of these hotel conversions will probably flip in 2 to 3 years. But we still set expectations conservatively. It may take 5 to 7 years for the last asset to exit the fund. IRA friendly, we have no leverage on a fund level. The projects themselves do have leverage. Consult your CPA about the UBIT, but we have no leverage on a fund level. And the fund pays 8% cumulative pref. Then it returns the capital to investors. And then the split for Class A units is 80-20, for Class B is 70-30. And we do make exceptions for people who have an IRA and they have special circumstances. They don't want to write $250,000 check. From time to time, we'll make an exception and take less. That's basically how the fund works. Yes, there's a double waterfall. For those who are obviously familiar, when you invest in a fund, my team basically is a fund management team. So we do get compensated 2% asset management fee. And we are motivated to receive the back-end promote. What our primary job is to identify the deals with the best economics, not available to public, or sometimes they're available to public, but negotiate better terms. At the same time, we diversify the risk among many projects. You could do well or better investing directly into a given asset. If that deal does great, phenomenal. But if the deal runs into a problem, the fund also becomes a safety mechanism, the diversification mechanism, smoothens the ride. It kind of smoothens the journey, in a matter of speaking.
Question on this one?
Say it again.
A question on this one. So do all the investors they actually invest on closing, or because it's got a 2-year raising period, you could have them coming in at different points in time?
Yeah, that's a great question. So the only differentiator between early and late investors is 8% pref. So the pref starts from the day of the capital call. So again, the fund is a closed-ended fund. When people invest, they pledge the capital. When we have a deal, we call in the money. It's called capital call. And that's when the pref starts. So by the time the fund closes, at that point, all investors own percentage of the fund proportional to their capital invested. So an example, it's a $25 million fund. If somebody invested $250,000, they would own 1% of the fund. The pref is different because people invested at different times. So the accumulated pref is a little different. So there's a little bit of benefit to come in later, in a manner of speaking, right now, towards the end of the fund, because the 8 pref is lower than the target return. The concept is called yield stripping when you come in at a late stage of the fund, because your target return 12 to 18, but the pref is only 8. Does that make sense?
Yeah, and one follow-on question. So does that mean that there's no, because it's only pref, and no back-end payout, so there's no need for doing kind of quarterly valuations and trying to figure out what's the entry price for somebody who's coming in late? Like it's all, essentially everybody is investing at the same entry price.
Correct. Yeah, we don't do quarterly mark to market. We have another fund, Tempo Opportunity Fund, which is an open-ended fund where we do quarterly adjustment of the NAV because we do quarterly subscriptions and redemptions. Here, there is no such thing. It's basically the only differentiator is the 8 pref. You come in early, your clock starts early. You come in later, your clock starts early on the pref. But
Go
ahead.
So for the other one, essentially every quarter end, there would be an entry price at which somebody could come in, or an exit price at which they could cash out.
Yeah, exactly. Because we do quarterly redemptions, subscriptions, and distributions. We have to do quarterly, essentially, what they call it mark to market. We basically go through our portfolio and we look at the assets, and some stuff gets marked down, some gets marked up. So we do it to the best of our ability on a quarterly basis. Honestly, I have to say, as a fund manager, that model is painful to execute. So we do it, we run it, we know how it works. This structure with a closed-ended fund is a lot easier to manage because there's no quarterly mark to market. There is no redemption in the middle of the fund. You go in for the life of the fund, but you capture all the benefits of the upside as well.
Mm-hmm. Thanks.
Sure. Yeah, let me just finish and then questions. Again, just a couple of why folks invest with us. Experience, been fund manager since 2009, real estate investor since 2000. We have strong track record. Diversification, again, this is one of the key benefits of a fund. We continue to invest in a broad range of assets, spreading the risk among many sectors, opportunities, locations. A lot of our hotel conversions, they're not scattered into one location. They're all over the map. Why? Because this is where the opportunities were good. So we're all over. It's almost like we don't have any 2 projects in the same city. So diversification is a key benefit. Best access point, basically do 2 things. One is that we offer deals that's not available to public. Some of these deals literally close privately, and then they're only available to our fund investors. The sponsor comes in saying, we're raising $4 million. What do you guys want to take? And if we'll take $1 million, I will often pick up the phone. I'll call another fund. They'll take another $1 million, and we basically do kind of friends and family quickly fill these deals. So you get access through us into some of these deals. And then from time to time, we'll go into another fund where we will negotiate a side letter and improve terms. So some examples, we have funds with $2 million minimum, and we've written a check, one from Tempo Opportunity for $1 million, one for Tempo Growth, to get into Class A units, which have better economics than if you write $100,000 checks. By writing bigger checks, we wind up getting better terms. It sort of justifies the fact that we have our own management fee and our own waterfall. It's not always equal, but it's a decent trade-off. Again, business philosophy, our investors come first. We pride ourselves on white glove service. We use third party, after Bernie Madoff, if you do it in-house, you could do a great job, but investors should always be concerned are the books done straight. So we use third party administrator, very reputable, and we use obviously third party SEC counsel. And all the communications are done through online portal, quarterly statements, email, investor calls. We were running virtual meetings. We are not yet doing any physical meetings yet. And here's Alina, and Alina is our head of investor relations. If you have any interest, feel free to reach out to her or reach out to me. Happy to answer any questions. And you can schedule a call with me through the very cheesy name called bigmikecall.com. Again, Big Mike. I couldn't get more creative. So it's easy for people to remember to schedule time to chat. Questions?
Great. Thank you, Mike. That was great. And those were some amazing deal examples, actually. I'm going to be going over that later as well. We have a few questions on the chat already. So, so what would you say is the differential in cost of conversion of hotel to apartment per square foot versus new construction cost per square foot?
Yeah, that's a great question. Typically, there's at least 20% difference, especially in today's day and age of construction material costs having gone up so much. It really depends on the, project by project, but 20% ratio is a good minimum. It's a good differentiator. In general, the newer product, first of all, it can look different, right? You're not going to build exactly the same units as the hotel conversion looks like. But if you were to reconstruct exactly the same configuration, exactly the same layout, it's typically at least 20% delta. Does that make sense?
Wait, so the 20% is between the per square foot hotel cost versus apartment cost, or what sort of between cost?
No, the difference between new construction cost per square foot is at least 20% versus converted cost.
Okay, good. Mm-hmm.
And I just, again, the point that I just mentioned, people don't build converted hotels, new construction, they build normal apartments. So the configurations will look different and the cost per square foot may look very different. These are smaller, typically units. And in fact, the cost per square foot could be even better than 20% because they're smaller units. Smaller units rent typically at a premium per square foot versus the larger units. Does that make sense?
Sure. But in terms of, let's say, what makes the general strategy kind of high yield, or like not high yield, let's say high value add, in the sense like where is the spread coming from? So if you have a hotel now, so let's say, and you are able to, from a zoning standpoint, to repurpose it into a multifamily. What is a situation that makes that, generates that spread? Is it that the hotel is cheaper per square foot? Is it like what is like a rule of thumb?
Sure. So the cap rates on hotels is substantially higher than the cap rates on multifamily.
Well,
that basic premise creates the opportunity. So give you an example. I actually was in Orlando, was looking at a potential project. We wound up not doing it. But the revenues, if you can get the revenues from the monthly rent close to the revenues as a functional hotel or better, you're already ahead for the reasons that the hotel operation is expensive. Your expense ratio is a lot higher than expense ratio on multifamily. Not a lot, but higher, because you need staff to clean the rooms. You need to do more active maintenance. You have a turnover of the clients. There's a higher wear and tear. So the multifamily converted property, you have essentially substantially better cap rates. You have a typically lower expense ratio. So if you get your revenues up, not even necessarily to the same level as a hotel, you will increase the value just from that point of view.
Yeah, so from that point of view, like arithmetically, I agree, and I get that, but purely, if you have the cap rates are higher on a hotel just on the revenue side, but is there a kind of a physical side to it that allows for then the converted multifamily? Because that's what you're looking for. You're looking for a converted multifamily has a higher cap rate than another multifamily one would acquire. That's kind
Right.
of
So the way, again, this is now we're jumping into underwriting. You're basically looking at an asset. You're looking at what capital you need to spend on renovation, roof, siding, internal, and your total cost. If you were to build this again, you have one metric sort of is on reconstruction basis. You're building the asset, you're converting the asset versus the similarly built asset at a below reconstruction cost, say about 20% below. And on the other side, you're really looking at the economics, right? You go in and you spend an additional capital, but because of the cap rate delta and lower expense ratio, the underwriting is pretty much what can you sell it at upon full stabilization, and you're running the math. It's very much math exercise. It's not really a cost basis. If you can get into the deal at a great cost basis, but you can't get the right rents for these properties, and your cap rate math doesn't play out, you just did a lot of work on no upside. So from that perspective, you really have to go through the underwriting on the end product. What can you rent these rooms for? What's the expense ratio? What's the NOI, and what's the cap rate you could sell them at? That's the basic stuff. So I don't know if I answered the question, but it's really mathematical exercise much more than, do I keep it as a hotel? Do I convert it?
Yeah.
The way you described it right now, it almost sounds like a no-brainer, right? If you can get the higher cap rate, lower operating expenses, it would seem like people would be rushing to do much more of this.
Yes and no. Again, and just to be clear, I'm not an operator. I'm a fund manager, and we're investors in these projects. So the bottom line is, and we've looked at a couple of projects with the partners to do it ourselves, and what we see is substantial construction risk. So ability to execute construction on budget, on time, and to get to the end result is what we're concerned about. So we walked away from a property. Also location. That property was right next to another deserted hotel, and we were not comfortable with the location being sort of next to a boarded property. It's a mix of many variables, obviously location and the execution strategy, and a lot of, back to your comment, I do know a number of sponsors who are trying to execute the strategy. There's still substantial risk, and the strategy is young. So we're yet to see how many of these projects will succeed and how many will have problems.
And let's say, before we go onto the other questions, so let's see the physical restructuring of a hotel to a multifamily. So is it going to be like making the multifamily of studios essentially? And that's like sort of the affordable housing argument. That's kind of what's more feasible, right? It's an affordable housing multifamily that has small units, maybe. I mean, unless it's a bigger value add, like sort of more extensive renovation. Is it sort of adding kitchens? Is that kind of what is a baseline? Like in simple.
The baseline is you have to add kitchenettes, right? You have to add. You don't have an option. You don't have an apartment. You won't get it approved. The certificate of occupancy will not take place unless you have a kitchenette in every apartment. So studios is your smallest configuration, and you can do some. So it's a supply demand. You need to analyze a given area and the demand. If you have demand, a lot of students or folks who are looking for studios, if the demand for that product is high, then perhaps you do more of that. If you see that you need to have some bigger units, then you reconfigure, so you break some walls. So it may not be all studios, it may be a mix of some turn into one-bedroom apartments and some are studios. That analysis depends on feasibility and kind of supply demand in a given area.
Yeah, understood, and that's great information. But let's say your opportunity, like you said, in part arises from sort of having this cap rate differential, right? Where the hotel in the first place, you kind of use it as a benchmark. You try to get the multifamily something comparable and raise the appraisal, right? But that benchmark is not an apples to apples benchmark because it's based off hotel revenue. So it's sort of like assuming that, let's say, a multifamily of studios is a high NOI multifamily, right? It's a little bit, it's not directly straightforward that you would be able to have the multifamily at that cap rate, since it's a different.
That's right.
Have any relevance at all, like in theory. But maybe
Well,
it does, because it's kind of still like split into all those smaller units. So that kind of connection I'm trying to understand better, honestly.
but I can tell you what I've observed. Again,
Yeah, exactly.
in the extended stay hotels, that flavor is very straightforward. You're picking up hotels that look like mini apartments. That is a fairly easy lift,
Yes.
and it's a lot easier to convert, and it's a lot easier to basically estimate the revenues. On the other side, the other flavor is when you're taking these.
Yeah, and Mike, sorry to interrupt, but let's say in that scenario that you mentioned, that is like a great baseline one, let's say that is like very similar, right? You kind of imagine it as apartments already. But then
Correct.
in that scenario, the initial, so let's say the per unit NOI, is it going to be the same for an apartment versus a hotel, or it could be a big enough differential where it's just such as the differential between the hotel and the regular multifamily? But that's not what you have experienced, because you kind of have like your intuition and you have your genuine like real life experience of it.
So Stefan, I completely hear you, and I can tell you this again. I was in Orlando. I went and looked at one of these properties near Disney World, I can tell you one of the three buildings in the hotel was basically dysfunctional because deferred maintenance, and the owner never had the budget to do it. So it really depends what state the hotel is in. If one of the three is dysfunctional, what if it's two of the three are dysfunctional? So it's almost to the point where it needs an investment. Either you can obviously invest to bring it back as a hotel, or you can invest to convert. As far as will you have higher revenue versus would you have a higher revenue per door on a hotel versus multifamily? It depends. So I can tell you this: when we were in Orlando, the hotel was basically full because there's a spike in demand right now. There's an artificial recovery. This was destination vacation spot, so it felt like the hotel recovered to a full occupancy, and we tried to lowball and the sponsor wouldn't sell because they felt that things are coming back. But imagine you have a situation where it's a business hotel or a hotel that's not seeing this kind of recovery, and the sponsor may be much more motivated. So at the end of the day, I think it comes down to how well can you buy it. On the revenue side, we were projecting revenue on that hotel the same for a monthly rent of around off the top of my head, like $800 a month, maybe $750 to $800 on a studio, versus that hotel was renting. It was a hotel like a motel at $45 a night. And normally hotels don't have 100% occupancy. So if you do 20 days, it could have generated somewhat higher revenue as a hotel. So it depends. It was a trade-off. We were trying to lowball, and that's why we're not willing to pay the price that the owner wanted. And you're absolutely right from the point of view that you have to judge your revenue per room per month versus and it's typically daily rate multiplied by the occupancy. I think it's called average ADR. That's what they call it in the hotel in the industry. Your ADR, if your ADR is a lot higher than the monthly rent, then it's not a good hotel conversion project. But if you can convert and get your monthly rent to be on par with that, then it becomes a viable alternative.
Right, and it's also maybe just more distress, and again, I don't know, maybe just more distress in the hotel space in the first place. So you kind of get more dislocations there for some.
That's right. So give you an example.
Yeah.
The one I mentioned in the Winston-Salem, that hotel was in foreclosure pre-COVID. It's almost like COVID hit and it completely knocked it out. The operator didn't run it well, and they weren't operating at a profit. They were basically at that point going through foreclosure. They were just taking all the revenue and not really paying the mortgage. So if you find that kind of a situation, then it's an opportunity. Of course, you want to find the distress. If there's no distress, you're not going to get a deal out of it.
Yeah, and there is probably more distress in hotels than in multifamily, which is high level speed.
Today, finding distress in multifamily is very hard. I can tell you where I see distress in multifamily today. We actually have a project in southern Georgia, in Warner Robins and Albany, 730 doors across 5 properties. And we invested in the deal when it was 50% occupancy, and the sponsor did heavy lifts, a lot of renovation, and they got the properties to the market, but they're having problems with the collections. For some reason, they are not managing the properties well, and they are using the excuse of the moratorium on evictions. But to make long story short, they are struggling to get the property all the way to the full performance. So they're selling it right now to the next guy or girl who's going to be running the property from that 75% collections all the way to the 100. You still have some distress and opportunity. The stress now is less than before, but the challenge to take it all the way to the full performance is not up to the sponsor who we invested with. So we're getting good return, good exit, but the sponsor doesn't have the management to take it all the way to 95% occupancy, or whatever it is, 92%. These opportunities exist today. So I call them moderate value add, because you're coming in, you're getting uplift on the price if you can execute. So an example of that property, the sponsor estimated fully stabilized this property would be worth 40 to 41 million, and he's selling it 35 to 36. So there's that uplift for the next person to come in, finish the property, not from the construction standpoint, but from the better operation, better management, get better collections, get it to the point where it's performing fully, and then they have their upside from there. So you see those opportunities, but they're not, it's not massive motivation.
Yeah, understood. And yeah, so next question on the chat that we have is typically how much experience and what criteria do you look for when funding and choosing operators?
Yeah, so it's a great question. We do want to see, again, some projects, I would say at least a couple of years. This is really interesting question from the point of view that if you really try to pick the winners with a lot of experience, the terms are not going to be as good, or they're going to have programmatic capital already set up. So you're looking for sort of what I call them emerging stars. It's not a perfect world, but my observation as a fund manager, and this is not just applicable to any asset class, but any strategy, you're looking for emerging stars. So we're working on a deal right now. The sponsor has 2-3 years experience. They're not a big player yet. They're not running massive operation, but they have high integrity. They come highly recommended. We feel great on a personal level, but they don't have 10 property. They've gone full life cycle. That would be nice. That property, the sponsor we invested in Indianapolis, I was showing you Riverbend deal. That's a sponsor with a full life cycle. And that sponsor doesn't take small checks. So we wrote him $3 million check. That was probably the smallest he would have taken. So you could probably approach bigger sponsors and try to become a programmatic source of capital. You just got to have more capital, number one. Number two, they got to be in a position where they don't have high programmatic capital, and also the terms. There's a lot of money chasing deals now. So if you pick a very experienced operator, they probably have all kinds of low capital cost suppliers of capitals, family offices, some small institutional. So what happens is we try to source some deals from them, but on the other side, we're looking for the emerging stars from the point of view that we can still negotiate better terms with them. And this is what our job is, to find some of these better operators with better terms. The risk profile is not necessarily higher or lower, because on one hand, you have these high operation, high experience operators, and they're great, but because their reputation becomes part of a risk reduction, they usually pay lower terms. So it's a trade-off, a little bit higher risk on the operator, but a little bit better terms versus kind of more competent operator, worse terms. It's a trade-off. I don't know if I answered the question, but that's how we think about the problem.
Right. Yeah, that's great. That's great. And the next question that we have actually is, a bit related. So what's the percentage of deals that you find through one, brokers, two general partners, and three yourself?
So it's a great question, and thank you for asking the question. I would say we don't find anything through the brokers at all. The products that are marketed heavily through brokers, unless it's a pocket listing, it's really hard to get a great deal. Most of what we do, and again, this is how I know business, because we operate funds of funds, we are looking for these operators who source that deal flow, and some of them source the deal flow from brokers, mostly source the deal flow using the following technique. And I've seen this work better than anything else. Generally speaking, very competent, localized operators who know the properties in a given area. They think about what do they want to buy. I'll give you an example, this operator in Midwest. He's got a massive footprint in Indianapolis. So what he does is he basically finds the targets he wants to buy, then figures out who are the owners and gets to play golf with the owners or break some bread, and basically builds the relationship with them. So when they're ready to sell, he's the first phone call. So these deals essentially don't get heavily marketed. We like those as much as possible. I do know people who source their deals through broker network and do a lot of analysis. I don't have exact answer because we don't source the deals directly. When the deals are sourced, we actually get to look for a deal that has already been sourced. Sometimes we'll ask, how did you find this deal? And you hear, well, this was a foreclosure, like a couple of hotels I mentioned to you. We picked them up from the foreclosing bank on our relationship. So we like those deals as much as possible off the market because they typically are better opportunities versus a broker marketed. And then yourself, again, we are actively searching for the best of the best. Sorry, let me take a step back. We are not actively searching for the operators. We actually have a pretty strong network of operators. So I go to a number of top masterminds around the country, and I spend time networking with what I call them top movers and shakers. So they bring the deals to us. We get a phone call. Hey, Big Mike, I have this opportunity. Can you take a look at it? What do you think? So I get involved in early discussions with some of the guys and girls that I know from the past. So this is how we source the deal flow through relationships. It is not us going out there and sourcing the deals. We source strong relationships first. The relationships bring us the deals, and then we negotiate terms, underwrite, bring in other fund managers, sort of strengthen numbers to get those deals done.
That makes sense. So guys, we are actually well over time. I had a few questions, quite a few questions myself on my end. So if you have some questions that you would like to address, feel free to speak up or just put them in the chat, like maybe like last question before we let Mike go.
Yeah, I apologize. I actually have to drive to the airport, Newark Airport, to pick up my daughter. She's landing, and okay. I'm good. I can do another 5-10 minutes, but that's about it. I apologize. Reach out. Happy to chat afterwards. Just forgive me. I do have to pick her up.
Absolutely, absolutely. And thank you for taking all this time, and it's been like really great and really informative for myself and everyone. Thank you, Mike. So do make sure to Mike or Alina, if you want to bring up once again the email.
Yeah, let me bring this thing up. Sorry, I just can you see this?
Yep. So it's Mike at tempofunding.com, Alina at tempofunding.com. So do make sure to reach out. Thanks to everyone for joining today, and thank you, Mike, so much.
Thank you, Stefan, and thank you everyone for listening. I appreciate your kind invitation, and hope everyone has a great evening.
Yep. Have a good night.
You too. Bye-bye.